The most important earnings report was Oracle. The company upped its annual CapEx budget from $35 billion to $50 billion, and the market did not like that, and the stock went down 11%. On Friday of last week, Netflix announced the purchase of Warner Brothers. Paramount made a hostile offer for Warner Brothers. There's a lot to say here. By most estimates, 2025 GDP will have grown by 2%, and virtually all of that growth is from hyperscaler AI CapEx. Take out that, and we have no GDP growth at all. The stakes here are huge. If, and it's a big if, that continuing to scale ever larger models, for example, ChatGPT 1 to 5, is beginning to lose efficaciousness, and that to go to the next level we need new research, then the hyperscalers at some point will slow down their purchase of chips, and the entire virtuous cycle will reverse. Hi, this is Steve Eisman, and welcome to another edition of The Weekly Wrap. This is for the week ending December 12th, 2025. Although earnings season seemed to be over, it started up again because there are some companies that have a January fiscal year. So Oracle and some other companies reported. And we will talk about some of them first, and then deal with Netflix-Warner Brothers merger and some new emerging risks for the future of AI. Before we get to any of that, the year is approaching its end. Next week, I am posting a lecture on the causes of the great financial crisis. It's in two parts. Part 1 posts Monday, December 15th. We will then post one more wrap on December 19th. That final wrap will be a review and analysis of the year, and then we will post Part 2 of the Great Financial Crisis lecture on December 22nd, and that will be our last episode for the year. We will start off 2026 on Monday, January 5th, with a conversation with Dan Ives, the tech analyst at Wedbush, and Chris Verone, the market strategist at Strategas, which promises to be exciting. Now on to the news of the week. On Wednesday, the Fed cut by the expected 25 basis points. The vote was 10-3. 2 voted against any cut, and 1 voted for a larger cut. Powell also signaled that future Fed cuts will be tougher to come by, but it won't be up to him because at the next Fed meeting, Powell will no longer be chairman. And now some earnings. The most important earnings report was Oracle, which is at the center of the AI debate. Why? Because, on the one hand, Oracle's revenue and backlog have been turbocharged by AI demand. That was made clear when it reported third quarter results. But what was also clear was that Oracle cannot meet this demand from cash flow like Google and Microsoft can. That is why debt on Oracle's balance sheet has exploded as well. That's why, when Oracle reported third quarter results, the market first focused on the revenue and backlog growth, and the stock jumped from $230 to $330. As the market turned its gaze to the balance sheet, the stock corrected to a level below where it was before it reported. So prior to reporting fourth quarter Wednesday night, the stock was $223. So how did Oracle do? Oracle has a history of occasionally disappointing. It did so last quarter on revenue, but because the backlog was up so much, the stock soared, at least at first. Well, Oracle did it again. It beat on earnings per share, but missed on revenue. But this time, the strong backlog at $523 billion, up from $450 billion last quarter, was no longer such a surprise. The company, however, upped its annual CapEx budget from $35 billion to $50 billion, and the market did not like that, and the stock went down 11% after hours Wednesday night. Investors are still worried about how Oracle is going to finance this $500+ billion backlog. A bit more on earnings. On last week's wrap, I discussed the poor state of housing. 2 pieces of housing earning news this week that reinforced the thesis. Toll Brothers reported. Revenue was up 4.6%, but earnings per share was down 1%, which goes to show how much incentives continue to hurt margins. And At $5.5 billion, the company's backlog was down 15% last year. Down 15% last year. That does not bode well for future earnings. Also, Home Depot had an investor day this week. It issued earnings per share guidance for 2026 of 0 to 4% growth versus expectations of 5%. Not so great. Let's move on from earnings and discuss Warner Brothers. 15 years ago, on December 2010, Jeff Bewkes, the CEO of Time Warner, said the following about the nascent threat from the tiny Netflix. Quote, "It's a little bit like, is the Albanian army going to take over the world? I don't think so," unquote. Well, looks like the Albanians won. On Friday of last week, Netflix announced the purchase of Warner Brothers for a total enterprise value of $83 billion, $72 billion equity value, or $27.75 per share. And on Monday of this week, Paramount made a hostile offer for Warner Brothers with an offer of $30 a share in cash. The new bid tops Netflix's bid, not least of which because Netflix is only interested in the Hollywood studios and the streaming business and will spin out or sell the rest. Paramount wants it all. We shall see if Netflix raises its bid. There's a lot to say here. And let's start with a gross injustice. CEO David Zaslav put together the Discovery-Warner combination in 2022. And what did he accomplish? On the day of the merger in 2022, Warner Brothers' stock price was $24. About 6 months ago, this stock was $7.70. Fundamentals were awful. The company is barely breaking even. And Zaslav now just sold the company for $27.50. It's hard to imagine a worse job being done by a CEO. Yet, during his tenure as CEO, Zaslav got paid about $150 million combined in compensation for destroying the company. And with this transaction, Zaslav will make an additional $550 million. There really is something wrong with corporate America when a CEO performs abysmally and gets compensated as if he is a heroic success. It's disgusting. It reminds me of Jeff Immelt, the former CEO of GE. He destroyed the company and made over $200 million in the process, plus, by some reports, an additional $200 million in a retirement package. Let's assume first that Netflix wins. Will that deal go through? I have major doubts. Netflix's streaming market share is 20%. HBO's is 15%. So the combined entity has 35%. Jessica Reif, the media analyst at Bank of America, said that if this merger goes through, the streaming wars are over. From an antitrust perspective, the key will be defining the market. Those against the deal will simply say that the combination has 35% of the streaming universe, and that is just way too high and will kill competition. Netflix will argue that the market is not just streaming, but YouTube, TikTok, and X are included in the market. I find that argument a stretch, but we shall see. There is also a political element here. The Trump administration appears to favor the Ellisons in this deal, so we will just have to see how the politics play out. As for the Netflix-Warner Brothers potential merger itself, on paper, it makes a great deal of sense. Netflix gets an incredible library, a studio, and a premium streaming service. Lots of cost-cutting here. But in my years of investing, I've noticed that many M&A transactions fail, and even more just plain underperform expectations. Making an M&A deal work is hard. The ones that succeed are successful because the buyer has a culture of doing M&A transactions. That is an art in and of itself. Netflix has never done a transaction of anything close to this size. This won't be an easy deal. Warner Brothers has been bought and sold many times. It has a tough, balkanized culture, such that the only people who benefited from its mergers were the executives, who all got paid a lot. This is a very high-risk transaction, and if I was a Netflix shareholder, I'd be very nervous, especially given the potential for regulatory delay. The longer the delay, the more management will be distracted. If I had to lay a bet, I'd say that the odds favor Paramount. And on Monday, it was also revealed that Jared Kushner's private equity firm is part of a syndicate backstopping Paramount's bid. And now that Paramount has made a higher hostile bid, it's now completely unclear who will get this trophy property. Changing the subject, now I want to return to the risks inherent in the AI world. Everyone wants to know if there is a bubble, and I've spoken about this a lot. For me, this is different from predicting the great financial crisis. Back then, the center of the universe was the large banks, the securitization world, and the financial system. That was my area of expertise. My partners and I did our own research, and eventually we figured it out. It took all of us working as a team to do it. This is different. I don't know how to code. I'm not a computer scientist. So everything I know here is from what I read. But that doesn't mean I'm complacent. I'm a long-term investor, and for quite some time, I've owned and still own many tech stocks in my portfolio, and many of them are AI-related. So, like everyone else, I'm trying to figure out the risks involved in sticking with these investments. I am not willing to make a major negative call here like Michael Burry is doing. I'm still just trying to figure out the risks. Hi, this is Steve Eisman. Not that long ago, the words private citizen meant just that, private. But now there are data brokers collecting and selling your data. These brokers are not selling products, they are selling you. Protect your data. I do. With ExpressVPN, your IP address is hidden. That makes it much more difficult for data brokers to track and monetize your activity. I use ExpressVPN to protect my data, and I find that it works great. With ExpressVPN, I know that my IP address is hidden. I recently traveled to a university to give a guest lecture. I was comfortable using the airport and hotel Wi-Fi's because I used ExpressVPN and knew that my data would be protected. ExpressVPN plans start at $349 a month. ExpressVPN encrypts 100% of your network traffic and works on all your devices. And for U.S. customers only, ExpressVPN plans include Identity Defender, a new suite of tools to get your data removed from brokers and even insure you against data theft for up to $1 million. Check it out. Secure your online data today by visiting expressvpn.com/Eisman. That's expressvpn.com/EISMAN to find out how you can get up to 4 extra months. expressvpn.com/Eisman. The fact that NVIDIA's revenue growth is so explosive is simply a manifestation of all the CapEx being spent by the hyperscalers. The key is whether all that CapEx will be worth it, and we still don't know. But doubts are starting to be expressed more and more, and I'm paying attention. And so should you. The latest salvo came from Ilya Sutskever, one of the founders of OpenAI, although he has since left the company. In a recent interview, he expressed 2 major points. First, he contends that the current LLM models will not ever achieve AGI, artificial general intelligence. Second, he claims that the scaling of ever larger LLM models is losing its efficacy. Quote, "We are no longer in the age of scaling. We are back to the age of research." He also said, "The thing which I think is the most fundamental is that these models somehow just generalize dramatically worse than people, and it's super obvious. That seems to be a fundamental thing." Unquote. A researcher at Samsung, Alexia Jolicoeur-Martineau, hope I pronounced that right, wrote on X last week, quote, "It's relieving to see that other researchers are finally seeing the light. We have been blindsided by LLMs. We need new methods if we want to truly achieve AGI." Unquote. The point here is that if, and it's a big if, that continuing to scale ever larger models, for example, ChatGPT 1 to 5, is beginning to lose efficaciousness, and that to go to the next level, we need new research, then the hyperscalers at some point will slow down their purchase of chips, and the entire virtuous cycle will reverse. According to one commentator, big tech needs $2 trillion in AI revenue by 2030, or all that CapEx will not generate a sufficient return. The stakes here are huge. By most estimates, 2025 GDP will have grown by 2%, and virtually all of that growth is from hyperscaler AI CapEx. Take out that, and we have no GDP growth at all. And all we'll have left is a K-shaped economy without the positive parts of the K. Again, this is not my area of expertise, but the risks here are enormous, and I will keep researching. And now for the mailbag. Every now and then, I just read an email that I've gotten. This is from a coder who describes what he perceives to be the real benefits for AI. Because of the length of the email, I've edited it down. This is from Sebastian. Hello, Mr. Eisman. I'm a big fan of the show. Finally, someone is making a show to teach people to think critically about stocks. Thanks. You're welcome. In past videos, you talked about AI and the impact it has and will have on productivity and the job market. I want to share my experience working, and he names a company you all would recognize, as a software engineer, 7 years in the industry. I can tell that we have seen massive improvements from AI. We are not replacing software engineers straight up, but AI is making each engineer 5% to 30% more productive. There is a wide range because it's difficult to measure and depends on the kind of work each employee is doing. Also, this measurement is empirical, but I can give you some examples that help me come up with those numbers. First, impact on non-programming tasks. This is one of the biggest improvements. Even though I'm a software engineer and I love programming, a lot of the job happens before coding. For example, every 2 weeks, every engineer has to spend 1 day triaging bugs. This means going through issues filed by users, categorizing them by priority, and assigning them to the right team. This is now made by AI almost entirely, and it is incredibly effective. So we no longer spend 1 full day every 2 weeks on that. That's a 10% improvement in productivity. Second, coding tasks. The biggest improvement here is on making code from scratch, such as making scripts or making the skeleton for a new library. That saves about 5% of time and reduces cognitive load. For large code bases, when updating and fixing existing code, the improvements drastically diminishes, and here I think you could see the negative effects of AI if its use is forced. AI can help with large code bases in different ways by assisting engineers analyze big files and brainstorm design solutions. An example of a prompt helping here would be, what is the intended function of this code file? This saves a lot of time and helps readers prevent missing critical information. Another massive improvement is on fixing issues. For one, parsing error logs, which is time-consuming. AI can, in most cases, understand and parse the error message very efficiently and effectively. This saves around 5% of time. Another improvement is where you have a very good idea where the error is, but still can't find it. For example, there is a big formula that is missing a +1 or has a sign flip from a plus to a minus. If you tell AI your hypothesis and where to look, it is very likely to tell you the exact error. It saves lots of time reading and analyzing. Here, the improvement is harder to assess, and it can make mistakes. Conclusion. This is Sebastian's conclusion. AI is here to stay. I can't conceive of doing my job anymore without having access to AI, and many of my coworkers agree on this, even the ones reluctant to change. Small comment. People with seniority seem to be even more eager for AI. All the AI infrastructure might be overhyped, but it is already making the software engineers more efficient, and we are creating more software because of it. Also, a big misconception is that people think that companies won't hire software engineers because the company will just replace that software engineer with an AI agent. But that is not the case. But the overall engineer hire efficiency allows companies to stop hiring more people. They are replacing people in the aggregate, but not entirely. I also struggle with online rhetoric about AI because a lot of people want AI to fail and not replace us. And I agree. But I think a lot of people try to just look at how it fails and doesn't work instead of looking at where it works. I think doing this is wishful thinking and it's dangerous. Last but not least, I think AI is like canned and processed food. It provides society with more goods or services in the case of AI. Processed food and cans prevent food from spoiling and provide lots of calories for cheap prices. Similarly, AI can generate entertainment and services way cheaper. But just as the side effects of processed food, like lower quality food, addictive food, and obesity, I'm concerned about what the side effects of AI would be. Thank you. Well, thank you, Sebastian. My comment here is that the AI software gains that he mentions sound impressive, but alone don't seem to justify all the enormous CapEx. We will need a lot more gains from AI to justify all this CapEx. And that's the wrap. This last Monday, I posted an interview with Nigel Coe, the industrial analyst at Wolfe Research. The conversation spanned the gamut of the space, but particularly touched on the incredible impact AI and AI databases are having on particular companies. So check it out. And this Monday, we will post part 1 of my lecture on the causes of the great financial crisis. Part 2 will post on the following Monday, December 22nd. Hope you tune in. I want to thank all my viewers for your support in 2025 and for your comments and participation that makes the work exciting and challenging. It's great to be in a conversation with many engaged, interested people. Please keep the comments coming. We will take a short break, and our last episode of 2025 will be Monday, December 22nd, and our first episode for 2026 will be Monday, January 5th. We want to wish everyone an amazing holiday season and Happy New Year, and I'm excited to share 2026 with my viewers and listeners. If you haven't already, please consider subscribing to our YouTube channel so you can receive these weekly wraps along with our podcast and the financial literacy masterclasses. Subscribing is the best way to help the channel, and we greatly appreciate your support. Also, be sure to check out our website, realeismanplaybook.com. There, you can easily access all our episodes, as well as the financial literacy masterclasses, our new blog, and some other goodies as well. Check it out, and see you soon. This podcast is for informational purposes only and does not constitute investment advice. The host and guests may hold positions in stocks discussed. Opinions expressed are their own and not recommendations. Please do your own due diligence and consult a licensed financial advisor before making any investment decisions.